All right, so today we're doing a deep dive into The Little Book of Valuation by Aswath Damodaran.
Oh, this is a great one.
It seems like it's pretty popular.
Yeah, Damodaran is kind of a big deal in the world of finance.
I've heard that, yeah.
He's a professor of finance at NYU Stern,
Okay.
and he's known as, like, the dean of valuation.
Wow.
So, yeah, he's written a ton of books and articles on valuation, and even has the super popular website where he, like, shares all these insights and data.
That's awesome. You know, this book promises to give us the tools to value any company, right?
Yeah.
Like from these massive corporations like Kraft Heinz, Google, down to like startups like Airbnb and Zomato.
Yeah, absolutely. And what's great is that Damodaran doesn't just throw, like, all these complex formulas at you.
Right.
He actually breaks down the process in a way that's understandable, even if you're not, like, a finance whiz.
That's what I'm hoping for. So before we jump into the nitty-gritty, can you give us a quick overview of like the book's main argument?
Sure. Damodaran's, like, central thesis is that understanding how to value a company is just crucial for any investor.
Oh, right.
Whether you're, managing millions of dollars or you're just starting to build your portfolio.
So it's not just for like Wall Street, like hot shots.
Not at all.
Okay.
He really emphasizes that anyone can learn the basics of valuation, and then they can use those basics to make smarter investment choices.
It's about empowering everyday investors.
Exactly. And one of the key points he makes early on is, like, this distinction between intrinsic value and pricing.
Okay, I remember this from the dot-com bubble. Like everyone was chasing prices, not the actual value of companies.
Right. That's a perfect example.
Yeah.
So, like, intrinsic value is what a company is truly worth based on its fundamentals, like its earnings, its assets, its growth potential. It's kind of like figuring out the actual worth of a house based on its size, location, and condition.
Okay.
So pricing is more about market sentiment, what people are willing to pay at a given moment.
Right, right.
Think of it like the listing price of that house.
Okay.
It can be influenced by factors like hype, speculation, maybe even fear, which might not reflect the house's true value.
So how do we like find those hidden gems, those companies where the intrinsic value is like way higher than the market price?
That's where Damodaran's tools come in.
Okay.
He walks us through these different valuation techniques, starting with discounted cash flow or DCF analysis.
Okay, yeah, I've heard of that, but it sounds kind of intimidating.
Don't worry. Damodaran explains it in a way that's actually pretty easy to grasp.
Okay.
Essentially, DCF involves projecting a company's future cash flows
Okay.
and then discounting them back to the present to determine their current worth.
So we're looking into the future and trying to estimate how much money the company will make.
Exactly.
Okay.
And then we use a discount rate to account for, like, the time value of money and the risk associated with those future cash flows.
That makes sense.
Yeah.
Like $1 today is worth more than $1 tomorrow. And a riskier investment should have a higher discount rate.
You got it. And DCF is just one of the many tools that Damodaran explores in the book. He also dives into relative valuation,
Okay.
which involves comparing a company to its peers.
Okay.
And for that, we use multiples like price-to-earnings ratios.
So we're seeing how the market values similar companies and kind of using that as a benchmark.
Exactly. But Damodaran cautions against relying solely on relative valuation.
Okay.
He emphasizes that multiples can be misleading, especially if you're not comparing apples to apples.
Right. It's important to consider things like growth rates and risk profiles and all of that.
Absolutely. And this is where things get really interesting. Damodaran argues that valuation is not just about, like, crunching numbers.
Okay.
It's also about crafting a compelling narrative about a company's future.
So it's like weaving a story about how the company will like create value over time.
Precisely. He really believes that the numbers should be grounded in a believable narrative
Okay.
about the company's competitive advantage, its market opportunity, and its management team's strategy.
So we need to like assess whether the story the numbers tell aligns with the story the company is telling. Right?
Exactly. And that's what makes valuation both an art and a science.
Yeah.
It requires analytical rigor, but also a healthy dose of judgment and intuition.
I'm starting to see why this book is so popular. It's not just a textbook. It's like a guide to thinking critically about businesses.
It really is. And it's packed with real-world examples, which really helps bring the concepts to life.
All right, let's dive into some of those examples.
Well,
Chapter 1 kind of sets the stage, right?
Yes.
Okay.
It's called Value More Than a Number, Understanding the Terrain. And it lays the foundation for everything else in the book.
So what are some of the key takeaways from this first chapter?
Well, Damodaran really drives home the point that valuation is not just for financial experts. It's a valuable tool for anyone who wants to make informed decisions about their money.
So he's kind of encouraging us to become our own valuation experts.
In a way, yes.
Okay.
He wants readers to understand that valuation is not about finding, like, the one right answer.
Mhm.
It's more about developing a framework for thinking about value and making judgments based on the information that you have.
I remember reading about how some investors actually avoided the dot-com crash
Yeah.
because they focused on intrinsic value instead of getting swept up in the hype.
That's a great example. By understanding the difference between intrinsic value and market price, those investors were able to see that many tech companies were wildly overvalued.
So it's about being able to spot those red flags, those times when like market sentiment is driving prices away from the real underlying value.
Precisely.
Okay.
And Chapter 1 also introduces this concept of bubbles.
Okay.
These are periods when market prices just become completely detached from intrinsic value.
Like the housing bubble in the mid-2000s.
Exactly. Damodaran shows how understanding valuation can help us avoid getting caught up in all that frenzy
Okay.
and making irrational decisions.
So it's a cautionary tale as much as it is like a guidebook.
Mhm.
It's about being skeptical,
Mhm.
doing your own research, and not blindly following the crowd.
You got it.
Okay, I'm ready to put on my thinking cap. What's next in our journey through the Little Book of Valuation?
So Chapter 2 is called Hit the Ground Running Valuation Basics.
Okay.
And this is where we get into the nuts and bolts of financial statements.
Sounds like we're about to get our hands dirty with some numbers.
Yes, but don't worry.
Okay.
Damodaran explains everything clearly and concisely.
So no accounting degree required.
No, not at all. He breaks down complex concepts like balance sheets, income statements, cash flow statements
Okay.
in a way that's really understandable even if you've never taken a finance class.
That's a relief.
Yeah.
I mean, those financial statements can be pretty intimidating.
They can be. But Damodaran uses real-world examples and walks us through them, step by step. He even highlights some of the limitations of these statements.
What do you mean by that?
Well, accounting rules can sometimes obscure the true financial picture of a company.
Oh,
They might not fully capture intangible assets like brand value or the potential for future growth.
so we need to dig deeper, look beyond just the numbers themselves.
Exactly. Damodaran really encourages us to analyze trends, consider qualitative factors, and use our judgment to get a holistic view of a company's financial health.
Okay, I'm ready to put on my detective hat and start investigating some financial statements. What's next?
Okay, so in Chapter 3, Value the Business or Just the Equity, Damodaran dives into the world of discounted cash flow analysis, that DCF we talked about earlier.
Okay, so this is where we start projecting those future cash flows and bringing them back to the present.
You got it.
Okay.
This chapter introduces the two main approaches to DCF.
Okay.
One is valuing the entire business, and the other is valuing just the equity.
Can you explain the difference between those two approaches?
Sure. So when you value the entire business, which is sometimes called firm valuation, you're considering the cash flows from all the company's operations,
Okay.
regardless of how it's financed.
So we're kind of looking at the big picture, the cash flow before any debt payments or anything like that.
Exactly. This approach gives you a sense of the overall value of the business as an enterprise.
Okay. And what about when you value just the equity?
Well, then you're focusing on the cash flows that are left over for the equity holders after all the debt obligations are met.
Got it.
So this approach helps you figure out the value of actually owning a share of the company.
So it's like comparing the value of owning an entire house versus just having a mortgage on it.
That's a great analogy.
Yeah.
Both approaches have their merits, and Damodaran walks us through how to choose the right one,
Okay.
depending on your goals and the company you're analyzing.
So what are some of the key inputs that go into a DCF analysis?
Well, you need to start with a solid understanding of the company's current financials. Its revenues, expenses, and cash flows.
So we're looking at their track record to get a sense of their earning power.
Exactly. Then we need to project those cash flows into the future,
Okay.
which involves making some assumptions about the company's growth rate, profit margins, and investments.
That sounds like the tricky part. How do we predict what's going to happen in the future?
It's definitely challenging, but Damodaran provides a framework for making those projections.
Okay.
He emphasizes understanding the company's industry, the competitive landscape, and the management team's strategy.
So we're not just pulling numbers out of thin air.
Not at all. We're grounding our projections in a solid understanding of the business and its potential.
Okay. And once we have those cash flow projections, we need to discount them back to the present using that discount rate.
Exactly. And remember, the discount rate reflects the time value of money and the risk associated with the investment.
So a riskier company would have a higher discount rate.
Precisely. And that would result in a lower present value for its future cash flows.
Okay, I'm starting to see how all these pieces fit together. DCF analysis is all about taking those future cash flows, adjusting them for risk and the time value of money, and then figuring out what they're worth today.
You got it.
Okay.
It's a powerful tool for estimating a company's intrinsic value.
Yeah.
But Damodaran reminds us that it's not a crystal ball.
Right.
It's still based on assumptions, and those assumptions could be wrong.
So we need to be aware of the limitations and use our judgment when we're interpreting the results.
Absolutely. And that's where the art of valuation comes in.
Yeah.
It's about blending like the quantitative analysis with qualitative assessment and recognizing that there's no single right answer.
This is fascinating stuff. I'm already feeling a bit more confident about approaching valuation. What's next?
Let's move on to chapter 4. It's called Beyond the Numbers Relative Valuation, and it's all about comparing a company to its peers using multiples.
Okay, so instead of projecting cash flows, we're looking at how the market is currently valuing similar companies.
Exactly. We're using metrics like price-to-earnings ratios, price-to-sales ratios, and enterprise value to EBITDA ratios. And we're just seeing how our target company stacks up against its competitors.
So if a company has a lower price-to-earnings ratio than its peers, does that mean it's undervalued?
It could mean that, but it's not always that simple.
Okay.
Damodaran stresses the importance of comparing apples to apples.
What do you mean by that?
Well, you need to make sure you're comparing companies with similar risk profiles, growth prospects, and financial structures.
Okay.
Just because two companies are in the same industry doesn't necessarily mean they're directly comparable.
Right. So a high-growth tech company might justifiably have a higher PE ratio than like a mature consumer goods company.
Exactly. And Damodaran provides a framework for choosing the right multiples and interpreting them in a meaningful way.
So we need to be careful not to jump to conclusions based on just like one single ratio.
Absolutely. Relative valuation is a useful tool, but it's really important to understand its limitations.
Okay.
You know, it can be influenced by market sentiment, and it shouldn't be used in isolation.
So it sounds like we should always use the combination of different valuation techniques to get a more complete view.
That's a great takeaway.
Great.
No single valuation method is perfect.
Yeah.
Using multiple approaches can help us mitigate the weaknesses of each one.
Okay. I'm starting to see the bigger picture here. It's like being a valuation detective, gathering evidence from different sources, using our judgment to piece together a story about a company's value.
I like that analogy. And in the next chapter, we'll see how Damodaran takes that detective work to a whole new level.
Okay.
He brings in the power of storytelling.
Well, that sounds intriguing. I'm excited to see how he connects the dots between narratives and numbers.
Yeah. So let's dive into chapter 5. It's called Stories and Numbers, Narrative, Value, and Price. And it's honestly one of my favorite chapters in the book.
Okay, what's so special about this chapter?
Well, Damodaran makes this bold claim that every valuation is ultimately a story.
Okay.
It's a narrative about a company's future.
So it's not just about like crunching numbers in a spreadsheet.
Not at all. He believes that the numbers should be grounded in a compelling and, most importantly, believable story about how the company is actually going to create value.
So we're talking about understanding their competitive advantage, their target market, the management team's vision for the future.
Exactly. Damodaran encourages us to translate all those qualitative factors into, like, quantitative inputs for our valuation models.
So we're bridging the gap between, like, stories and numbers.
Precisely. And this chapter is all about building that bridge.
Okay.
To illustrate this, he uses the example of Zomato, which is an Indian food delivery company.
I've heard of them. They've been growing really rapidly in the past couple of years.
They have, and Damodaran walks us through the process of creating a valuation narrative for Zomato, starting with the overall market for food delivery in India.
So we're looking at the big picture first, like the size of the market, the growth potential, the competitive landscape.
Exactly. And then we zoom in on Zomato's position within that market.
Okay.
You know, its market share, its competitive advantages, its rivals.
And how do we translate like that narrative into specific valuation inputs?
Well, we need to consider factors like Zomato's revenue growth rate, its target operating margins, its investment needs, its cost of capital.
All those factors are influenced by the story we've kind of constructed about Zomato's future.
Precisely. The narrative guides our assumptions and helps us make, informed judgments about the company's potential.
So we're not just plugging numbers into a formula. We're using those numbers to tell a story about where the company's going.
Exactly. And Damodaran even explores alternative scenarios, like what if Zomato's growth is faster or slower than expected? What if its margins are higher or lower?
Like a choose-your-own-adventure for valuation.
That's a fun way to think about it.
Yeah.
It really highlights the point that there's no single right answer. It's all about making decisions based on the best information available.
I'm starting to see how this narrative approach adds a whole new dimension to valuation. It's pretty cool.
It does.
Yeah.
It forces you to think critically about the story behind the numbers and to consider a range of possibilities.
So we've covered the first 5 chapters of the Little Book of Valuation. Time for a quick recap before we move on.
This sounds good.
Okay, so Chapter 1 set the stage, emphasized the importance of valuation, the difference between value and price. 2.2, crash course on financial statements.
Yes.
Chapter 3 introduced us to discounted cash flow analysis. Chapter 4 was all about relative valuation using those multiples. And Chapter 5 showed us how to weave a compelling narrative into our valuation process.
You got it.
Wow, it's amazing how much ground we've covered already.
I know, right? And we're just getting started.
Okay.
Damodaran has a lot more to share about valuing different types of companies.
Okay.
From young growth companies to distressed companies.
Well, I'm ready to dive into those insights. What's next on our agenda?
Chapter 6 focuses specifically on valuing those young growth companies.
Okay.
You know, the ones that are often unprofitable. Maybe they have a limited history.
Right.
They operate in these rapidly evolving markets.
So we're talking about companies like Airbnb and Zomato back in their early days.
Exactly. And valuing those companies presents unique challenges because traditional valuation methods don't always apply as neatly.
How so?
Well, for starters, those companies often have little to no earnings.
Okay.
So using something like a price-to-earnings ratio just doesn't make much sense.
Yeah, that's true.
And their growth rates can be totally unpredictable.
They might explode one year and then completely fizzle out the next.
Yeah. So Damodaran introduces adapted DCF and relative valuation techniques that are more suitable for these high growth, high uncertainty businesses.
Exactly.
Okay.
You know, instead of getting stuck on traditional metrics like price-to-earnings ratios, he encourages us to focus on metrics that really capture the essence of their growth stories.
Right. So things like revenue growth, user acquisition, market share.
Yes, exactly. Things that give us an indication of their traction and momentum.
So it's about looking beyond the financial statements.
Yeah.
Trying to understand those underlying drivers of their business and their potential to really scale.
Precisely. Like, for instance, when he's valuing a company like Airbnb in its early days, Damodaran highlights the importance of a metric like gross bookings, which is the total value of all the transactions that are going through their platform. That makes sense. Because, gross bookings can give you a sense of the scale of the company, even before they have substantial profits.
Exactly. It's a way to measure the volume of activity on the platform and to assess the company's ability to connect those hosts and guests effectively.
So we're looking at the size of the pie that they're creating.
Yeah.
Not just the slice that they're currently taking for themselves.
You got it. And remember, valuation is all about constructing a narrative about the company's future.
Right.
And in the case of young growth companies, that narrative is often about capturing market share, disrupting industries, and creating entirely new types of products or services.
It's about anticipating how they'll transform the landscape.
Yeah.
And then assessing, how plausible that transformation is.
Exactly. And that requires a deep understanding of their target markets, their competitive advantages, and any barriers to entry that might protect them from rivals.
So it's not just about extrapolating their current growth rates.
No.
It's about assessing the sustainability of that growth.
Yeah.
And the factors that might accelerate or decelerate it in the future.
Precisely. And that's where Damodaran's emphasis on narrative becomes so important.
Okay.
The numbers have to be grounded in a convincing story about how the company is going to create value and overcome all those risks and uncertainties that come with growing so fast.
I love that analogy. It's like Assessing whether a company has the right ingredients and the right recipe to bake a delicious, lasting cake, not just a flash in the pan.
Exactly.
Okay.
We need to be able to see that potential end product, not just the raw materials.
So to do that, we need to understand the company's vision, their strategy, their execution capabilities.
Precisely. And we need to be able to assess whether the story that they're telling is actually aligning with what the numbers are saying.
It's like making sure the script and the performance are in sync.
You got it. Now, as companies mature and their growth becomes a little bit more predictable, the valuation process shifts a bit. Yeah. And in Chapter 7, Damodaran explores these nuances of valuing what he calls established growth companies.
Okay.
So these are companies that have proven their business models.
Okay.
And they've achieved a certain level of scale.
Okay.
But they're still expanding really rapidly.
So these are companies like Google or Amazon.
Exactly.
The giants in their respective industries with tons of resources and global reach.
Yeah, they might not be growing at the same crazy speed as those younger startups.
Yes.
But their growth rates are still impressive,
Right.
and their potential for continued expansion is huge.
And Damodaran recognizes that these companies present like their own unique valuation challenges, right? As their growth stories kind of transition from that initial like super high growth phase to like a more stable growth phase.
Exactly.
So we need to adjust our valuation models to reflect those changing dynamics.
Yeah, exactly.
So we need to adjust our valuation models to reflect those changing dynamics.
Precisely. He suggests using what's called a two-stage DCF model. Okay.
Where we project that high growth phase, and then it's followed by a more stable growth phase.
Okay, so we're basically recognizing that growth will eventually slow down, even for the most successful companies, as their markets mature and they get more competition.
Exactly. And we need to account for that slowdown in our projections. We use different growth rates and discount rates for each phase.
And figuring out when that transition from high growth to stable growth is going to happen, that seems pretty crucial.
It is. That has a significant impact on the overall valuation.
Yeah.
And that's where a deep understanding of the company's industry, its competitive landscape, and its long-term prospects becomes super important.
So we need to assess how sustainable their competitive advantages are, how effectively they're innovating and adapting to new technologies, and how they're positioning themselves for future growth.
Exactly. We need to be able to kind of project how their growth engines are going to evolve.
Yeah.
And whether they're going to be able to maintain their market leadership when new challenges inevitably come up. And that's where, like, the art of valuation really comes into play.
It does.
Yeah.
It's about blending that rigor of quantitative analysis with, like, intuition and judgment.
Right.
You really need a deep understanding of the business.
Yeah. So we're using the numbers as a starting point, but then we're weaving in those qualitative insights, industry knowledge, and, like, a sense of the company's overall trajectory to get a more holistic picture.
You got it. And that approach becomes even more crucial as we move into the realm of like mature companies in Chapter 8.
Okay. These are the companies that are often considered the bedrock of the economy.
Exactly.
The blue chip stocks, the household names with long histories of stable earnings, dividend payments.
Think Coca-Cola, Procter & Gamble, Johnson & Johnson, those kind of companies.
Right. They've weathered economic storms, adapted to changing consumer preferences, and like consistently delivered value to their shareholders over long periods of time.
Yeah, they might not be the flashiest or fastest growing companies, but that stability and resilience makes them attractive investments for a lot of people.
And Damodaran recognizes that valuing these companies requires a different mindset.
Yeah.
Right. It's less about betting on explosive growth and more about assessing their ability to maintain their strong position.
Exactly. He emphasizes the importance of assessing their operating efficiency.
Okay.
How well they're managing costs, generating profits from their existing assets, utilizing their resources effectively.
So it's like you're inspecting a well-built house, right? Checking the foundation, the plumbing, the electrical, making sure everything is solid, well-maintained.
That's a great way to put it. We're looking for any signs of complacency, inefficiency, or waste. Anything that might be dragging down the company's value. Are they getting the most out of what they already have?
So we're scrutinizing their margins, their asset turnover, their return on invested capital, to see if they're squeezing every last drop of value out of their operation.
Exactly. And we're also looking at their financial restructuring potential. Can they optimize their capital structure by adjusting their debt levels or their dividend policy? Can they unlock value by buying back shares or maybe divesting underperforming business units?
So, like, looking for ways to spruce up that house.
Yeah.
Maybe a fresh coat of paint, some updated landscaping,
Yeah.
just making it even more attractive.
You got it. And Damodaran provides a framework for analyzing those options and assessing their potential impact on the company's overall value.
He also introduces this idea of unlocking hidden value, which sounds interesting.
Yeah.
What exactly does that mean?
It's basically about finding those hidden gems within a company that the market might be overlooking. A company might have a business unit, for example, that's not performing as well as others, but it actually holds a lot of potential.
So it's like finding a dusty old treasure chest in the attic.
Yeah.
It might not look like much at first glance,
Right.
but once you open it up, you discover it's full of valuable jewels.
Exactly. Unlocking that hidden value could involve selling those assets, spinning them off into separate companies, or even just highlighting their true worth to attract more investors.
So it's about, like, seeing the potential that other people are missing and then figuring out creative ways to realize that value.
Precisely. And Damodaran reminds us that even in the world of mature, stable companies, there's always room for improvement, innovation, and value creation.
I'm starting to see how even valuing these seemingly predictable companies can actually be kind of a dynamic and exciting process.
It absolutely can be. And Damodaran's framework gives us the tools to help uncover those hidden opportunities and make informed decisions about the true worth of these often overlooked companies.
So we've talked about young growth companies, established growth companies, and mature companies. What other types of companies does Damodaran cover in the book?
Well, in Chapter 9, he takes us into a more challenging territory.
Okay.
This is where the stakes are higher and the risks are much greater, valuing declining and distressed companies.
Okay, this sounds intense. We're talking about companies facing serious headwinds, struggling to stay afloat, potentially even staring down bankruptcy.
Exactly. These are companies whose financial performance is deteriorating, their business models might be broken, and their futures are very uncertain.
So how do we even begin to value companies that are in such, like, dire straits?
That's a great question. Damodaran provides a roadmap for navigating these tricky waters.
Okay.
He recognizes that the traditional valuation methods might not be appropriate or they might need to be significantly adjusted.
Okay. So we need a different set of tools and a different mindset when we're approaching these companies.
We do. And Damodaran emphasizes the importance of making a clear distinction between a company's going concern value and its distress value.
Okay. Can you break down that distinction a little bit?
Sure. So going concern value is assuming that the company is going to be able to overcome their current difficulties,
Okay.
restructure their operations, and continue operating as a viable business.
So it's like we're assessing the value of the company if it manages to, like, turn things around.
Exactly. It's like estimating the value of a patient who's undergoing major surgery and intensive care. We're hoping for a full recovery, but we also have to be prepared for potential complications.
And what about distress value?
Distress value assumes a less optimistic outcome, either liquidation, where they have to sell off their assets to pay creditors, or a major restructuring that's going to significantly alter its operations and future prospects.
So it's kind of like estimating the, like, salvage value of the company,
Yeah,
if things really go south.
that's a good way to think about it. And when you're valuing distressed companies, you need to assess the probability of each scenario, survival versus failure, and weigh them accordingly in your valuation.
So it sounds like kind of a high-stakes game of probabilities where we're trying to figure out the most likely outcome.
It can be.
Yeah.
And Damodaran gives us a framework for estimating those probabilities. He looks at factors like the company's financial health, the dynamics of their industry, the strength of the management team, their access to capital, and their ability to actually implement a turnaround plan.
So we're not just looking at, like, the numbers in isolation.
No.
We're also considering, like, the context,
Right.
the leadership, the resources, the capacity for change.
Absolutely. And this chapter also gets into the complexities of valuing companies that have really big debt burdens,
Right.
which can amplify both the risks and rewards when you're dealing with these distress situations.
Debt can be a double-edged sword. It can, like, provide leverage, fuel growth in good times. But when things go bad, it can become a crushing burden. It can really accelerate a company's decline, make a turnaround that much harder.
That's a great way to put it. And Damodaran shows us how to incorporate that impact of debt into our valuation. We have to look at things like interest payments, debt covenants, and, the potential for default.
So it sounds like valuing distressed companies requires like a special set of skills and maybe a strong stomach for risk.
It does. But Damodaran gives us the tools to navigate these tricky situations and potentially find those hidden gems that other investors might be overlooking.
Okay.
Companies with undervalued assets or strong turnaround potential, or maybe even like unique opportunities that arise from these distressed situations.
This is really fascinating. It's starting to see how even these really challenging valuation scenarios can present some unique opportunities for savvy investors.
They can. And Damodaran's framework helps us approach those situations with a blend of caution and curiosity, recognizing both the risks and the potential rewards.
Now let's switch gears again and explore another specialized area of valuation,
Right.
financial service firms.
Right.
In Chapter 10, Damodaran tackles the unique challenges of valuing banks, insurance companies, investment banks, basically all those companies in the financial services industry.
These are companies that play a really crucial role in the global economy.
Right.
They provide capital, manage risk, facilitate transactions. They really enable economic activity. But their financial statements can be quite complex.
Okay.
You have a lot of intangible assets
Mm-hmm.
and exposures that are hard to quantify.
And their earnings, they can be super sensitive to interest rate changes, fluctuations in credit markets, and any kind of regulatory shifts.
Absolutely. And Damodaran adapts those traditional valuation techniques to account for these specific characteristics of the industry.
Oh.
We need a different set of tools.
Yeah.
And we need a deeper understanding of how the industry works.
So for example, when he's valuing banks, he really emphasizes looking at metrics like return on equity, regulatory capital requirements, the quality of the bank's loan portfolio.
Yeah, those metrics give you some insight into the bank's profitability, financial stability, risk management practices, basically its ability to generate sustainable returns.
And understanding a bank's business model, how it generates revenue, how it manages risk, how it's positioned within that whole financial services landscape. That's really important too, right?
Absolutely. Valuation is always about understanding the underlying business. And that's especially true for financial service firms, where all those financial risks and regulatory constraints are so complex.
It's kind of like trying to assess the health of a patient whose vital signs are constantly fluctuating
Yeah.
and whose treatment plan requires this delicate balance of like medications and therapies.
That's a great analogy. We need to be able to decipher the signals, interpret the data, and understand the underlying mechanisms that are driving that company's performance.
So we need a really solid understanding of the industry's regulations, its competitive dynamics, and all those macroeconomic factors that can impact its profitability.
You got it. It's like being a detective, right? Piecing together the clues, connecting the dots, forming a hypothesis about the company's true value.
Now, in Chapter 11, Damodaran takes us on a roller coaster ride through the world of cyclical and commodity companies,
Right.
where the ups and downs can be pretty exhilarating and terrifying at the same time.
Yeah.
These are the companies whose fortunes are really tied to those economic cycles and commodity price swings, often going through these periods of like boom and bust.
Exactly. We're talking about companies like oil and gas producers, mining companies, and manufacturers of cyclical goods.
Yeah.
Companies whose earnings can fluctuate wildly.
Yeah, they're kind of at the mercy of forces outside of their control.
Exactly. And Damodaran recognizes that valuing these companies requires like a different lens,
Okay.
one that really acknowledges that inherent uncertainty.
So how do we even begin to value companies where their performance can be so unpredictable?
That's a great question. Damodaran provides a framework. He emphasizes understanding the cyclical nature of their businesses and then, adjusting our valuation methods accordingly.
Okay. So we need to be able to see through those like short-term fluctuations and try to identify those underlying trends and drivers.
Exactly. One of the key techniques he highlights is normalizing earnings.
Yep.
You adjust the earnings to reflect what they would be in a more normal environment.
Ah, that makes sense. So it's kind of like if you're looking at the ocean, we're trying to smooth out the waves on the surface to get a clearer picture of the currents and tides that are really driving the movement.
That's a great analogy. We're trying to filter out the noise of the cycle and get to, like, the company's underlying earning power.
Okay. And how do we determine what a normal environment actually looks like for these companies?
That's a good question. You need a careful analysis of historical data, industry trends, those macroeconomic factors, and an understanding of where the company sits in the cycle.
So we're looking for patterns, trends, benchmarks that can help us establish that baseline for like what we might consider normal earnings.
Exactly. And we have to keep in mind that normal can change over time.
Right.
Technologies evolve, industries consolidate, global economic conditions shift.
So we need to be adaptable
Yes,
and like willing to revisit those assumptions.
absolutely. Now, when it comes to long-term growth prospects for cyclical and commodity companies, things get even more complex.
Yeah. I can imagine, yeah. We're not just dealing with like company-specific stuff now. We're also dealing with like global supply and demand dynamics,
Hmm.
technological advancements, geopolitical events, and all those factors that can affect commodity prices and like whole industry cycles.
You got it. And we need to consider all those macro level forces
Yeah.
and how they might impact the company's ability to make sustainable profits.
So it sounds like valuing cyclical and commodity companies really
Yeah.
requires a blend of like company-specific analysis, industry expertise, and macroeconomic forecasting.
It does. And Damodaran equips us with the tools and frameworks to develop all those perspectives,
Hmm.
so we can make more informed judgments, even with all that uncertainty and volatility.
That is incredibly helpful. I'm starting to see how Damodaran's approach to valuation can be applied to a really wide range of companies,
Mhm.
even those that seem particularly challenging or unpredictable.
And in the final chapter of the Little Book of Valuation, Damodaran brings all of these insights together, and he gives us this comprehensive framework for actually putting valuation into practice.
Okay, I'm eager to hear how he kind of ties it all together. What's chapter 12 all about?
It's called, fittingly, Putting It All Together, Valuation in Practice. It's the culmination of everything we've covered in the book
Okay.
and offers really practical guidance on how to apply it all in real-world situations.
So it's like a synthesis of everything, intrinsic value, relative valuation, the importance of narrative, the specifics of valuing different types of companies, the pitfalls to avoid.
Exactly. Damodaran revisits all those core concepts, and he draws on his experience as both an academic and a practitioner to give us this roadmap for navigating all the complexities of valuation.
That's fantastic. It's like getting a masterclass in valuation from the Dean of Valuation himself.
It is. And he doesn't just tell us what to do, he also cautions us against some of the common mistakes that can trip up even really well-intentioned investors.
So like, what are some of those common pitfalls?
Well, he highlights things like over-reliance on just one valuation method,
Okay.
ignoring those qualitative factors, failing to properly adjust for risk, and of course, getting swept up in market hype or panic.
Right.
That leads to biased or incomplete valuations.
So it's a reminder to be humble, to be thorough, to always be learning, always refining those valuation skills, and to like maintain a healthy dose of skepticism, even when everyone else seems to be like totally on board.
You got it. He emphasizes how important it is to be aware of our own biases.
Mm-hmm.
We have to challenge our assumptions, seek out different perspectives, and constantly test and refine our model.
So recognizing that valuation is not a one-time thing, it's an ongoing process.
Yeah.
You're always discovering, learning, adapting.
Exactly.
Yeah.
And Damodaran leaves us with what he calls rules for the road.
Okay.
They're like these guiding principles to keep in mind as we go on our valuation journey.
Those sound interesting. Can you share a few of the rules that really stand out to you?
Absolutely. One of my favorites is feel free to abandon models, but do not budge on first principles.
Ah, that's a great one. It reminds us that, like, models are just tools, not oracles.
Exactly. We shouldn't be afraid to adapt our models, experiment with different approaches, or even discard them completely if they're not working.
Yeah.
But we should always be grounded in the fundamental principles of valuation, understanding cash flows, assessing risk, and discounting future values to the present.
Right. Those are kind of like the bedrock.
Exactly. No matter what models or techniques we use.
Another rule that resonates with me is pay heed to markets, but do not let them determine what you do.
Yeah, that's a good one. It reminds us that markets can be irrational. They're emotional, they're prone to overreactions and mispricing things.
So we should pay attention to what the market's telling us, but we shouldn't let it dictate our decisions.
Exactly. We need to do our own research, form our own opinions, make decisions based on our assessment of value.
Right. Not just the whims of the crowd.
You got it. And that ties into another really important rule. Risk affects value.
Okay.
Now, this might seem obvious,
Yeah.
but it's easy to get caught up in the excitement of a company's growth or maybe the allure of a really hot market. and
Right.
forget about all those inherent risks that are involved.
Damodaran reminds us that higher growth often comes with higher risk,
It does.
and we have to factor that into our valuation.
Absolutely. It's not just about looking at the potential upside. We also need to consider those downside risks. What are the potential pitfalls, and what might derail their growth story?
Another rule that really kind of challenges conventional wisdom is growth is not free and does not always add to value.
That goes against the whole growth at all costs mentality.
Yeah.
Damodaran points out that growth requires investment, and those investments have to generate a return that's higher than the cost of capital.
Otherwise, that growth is actually destroying value instead of creating it.
Exactly. It's like spending $1 to earn 50 cents. It might look like growth, but it's eroding the company's worth.
So we have to be smart about growth, making sure it's translating into sustainable value creation.
Absolutely. And that leads to another important rule. All good things come to an end. Nothing is forever.
This is a good reality check. It reminds us that even the most successful companies will eventually see their growth slow down. Their markets mature, competition heats up, innovation becomes more incremental.
Exactly. We can't just assume that high growth will last forever. We need to adjust our models accordingly.
Right. So projecting a finite period of high growth,
Yeah.
followed by more moderate, sustainable growth.
Precisely.
Yeah.
And we have to estimate when that transition's going to happen
Yeah.
and how that's going to impact the company's cash flows.
And Damodaran also highlights truncation risk,
Right.
which is the risk that the company might not even survive to see their growth potential realized.
Yeah, it's a sobering thought, and it's especially relevant when you're valuing younger companies or distressed companies where those risks of failure are so much higher.
So we have to factor in the possibility that the company might not make it. That growth story gets cut short. And potentially, our investment is wiped out.
Exactly. We need to be realistic about those risks and adjust our valuation accordingly.
Another rule that I find helpful is look at the past, but think about the future.
Yeah.
It reminds us that historical data can be useful, but it's not always a reliable predictor of future performance.
We have to consider how all these things are going to change. The industry dynamics, competitive landscapes, macroeconomic trends, technological advancements.
Yeah.
How all those changes are going to impact the company's prospects.
It's about anticipating change, recognizing those inflection points, and then incorporating all those insights into our valuation.
Exactly. We're not just extrapolating from the past. We're really trying to envision the future.
Right. And Damodaran also encourages us to draw on the law of large numbers. An average is better than a single number.
Yeah, that's a great reminder about diversification. How important it is to manage risk and reduce the impact of any single investment going wrong.
It's the classic, don't put all your eggs in one basket. Advice applied to investing.
Exactly. By spreading our bets across multiple companies, we're reducing the risk of any one company failing or underperforming.
No, we're not just betting on individual companies. We're betting on the overall performance of that portfolio of companies.
Exactly. And that leads to another important rule. Accept uncertainty and deal with it.
It's a great mindset shift. Instead of trying to eliminate uncertainty, which is impossible,
Right.
we should acknowledge it and incorporate it into our decision-making.
Uncertainty is a fact of life when it comes to investing, and trying to ignore it or wish it away is only going to lead to disappointment and potentially some bad decisions.
So developing tools, strategies for managing uncertainty, things like sensitivity analysis, scenario planning, diversification, all those things can help us assess the impact of different outcomes and make better choices.
Precisely. We need to get comfortable with the unknown, recognize that we can't predict the future, and make decisions that are robust, even when facing a range of possibilities.
It's about accepting the limits of what we know and embracing that ambiguity.
Exactly. And finally, Damodaran brings us back to the importance of narrative with his rule. Convert stories to numbers.
Okay, that ties back to his point about storytelling. How powerful that can be in valuation.
It does. It reminds us that every valuation is ultimately a story about a company's future. And we have to be able to articulate that story clearly and convincingly using both words and numbers.
So we're not just crunching numbers.
No.
We're using those numbers to actually tell a story about the company's potential, its challenges, and its path to creating value.
Exactly. We're bridging that gap, between storytelling and the number crunching. weaving together those qualitative insights and the quantitative analysis to create this richer picture of the company's value.
It's like we're writing a biography of the company, using words and numbers to really capture its essence, its history, and its potential.
I love that. And I think those rules for the road provide a really good framework for how to approach valuation.
Yeah.
Combining rigor and creativity, blending the analytical with the intuitive.
They really do encapsulate Damodaran's wisdom and experience. They offer valuable guidance for all investors.
So as we wrap up this deep dive into the Little Book of Valuation, I encourage everyone listening to revisit those rules of the road. Embrace that ongoing process of becoming more confident and informed as you're doing your valuations.
And remember, valuation isn't about finding the one right answer.
It's about asking the right questions, making informed judgments based on the best information you have, and navigating those complexities of the business world. You're going to need analytical skills, qualitative insights, and a healthy dose of skepticism.
Absolutely. It's a journey, but it can be really rewarding, and it can lead to much smarter investment decisions.
Now, let's move on to Chapter 6, where Damodaran focuses on the exciting world of those young growth companies. The disruptors, the innovators, the ones pushing the boundaries of what's possible.
These are the companies that often really capture our imaginations. The ones with the potential to reshape entire industries and create entirely new markets.
They're often characterized by their rapid growth, innovative business models, and just a willingness to really challenge the status quo.
But they also come with a high degree of uncertainty, right?
Oh, absolutely.
Their futures are often unpredictable. It's hard to see their path to profitability. And, trying to value them can feel more like art than science.
That's right. And Damodaran acknowledges those challenges head on. He provides this framework for navigating the complexities of valuing these companies, and he recognizes that traditional methods might not work as well here.
So how do we approach valuing companies that might not even have positive earnings yet, or whose growth trajectories are so volatile?
That's a great question. Damodaran suggests looking beyond some of those traditional metrics, like price-to-earnings ratios, which might not be as useful in these early stages.
Okay. So we need to find other ways to measure their potential.
Exactly. He encourages us to really focus on metrics that capture the essence of their growth stories.
Okay.
So things like revenue growth, user acquisition, market share gains, other indicators of that traction and momentum.
So it's kind of like looking beyond the financial statements.
Yeah.
To try and understand those underlying drivers of their business, their potential to really scale up.
Precisely. For instance, when he's valuing a company like Airbnb back in its early days, Damodaran points to metrics like gross bookings, the total value of all the transactions happening on their platform.
That makes sense.
Yeah.
Because gross bookings can give you a sense of the scale of the company even before they have huge profits.
Exactly. It's a way to measure how much activity is happening on their platform and assess their ability to connect those hosts and guests effectively.
So we're looking at the size of the pie that they're creating.
Yeah.
Not just the slice that they're currently taking for themselves.
You got it. And remember, valuation is all about constructing a narrative about the company's future.
Right.
And in the case of these young growth companies, that narrative is often about capturing market share, disrupting industries, creating these entirely new categories of products or services.
It's about anticipating how they'll transform the landscape and then assessing how plausible that transformation is.
Exactly. And that requires a deep understanding of their target market, their competitive advantages, and any barriers to entry that might protect them from rivals.
So it's not just about extrapolating their current growth rate. It's about understanding how sustainable that growth really is.
Exactly. And that's where Damodaran's emphasis on narrative becomes so crucial.
Yeah.
The numbers have to be grounded in a convincing story about how the company is going to create value and overcome all those risks and uncertainties that come with growing that fast.
I love that analogy. It's like assessing whether the company has the right ingredients in the recipe to bake a delicious, lasting cake, not just a flash in the pan.
Exactly.
Right. We need to be able to see that potential final product, not just the raw materials.
To do that, we need to understand their vision, their strategy, their execution capabilities. And we need to be able to assess whether the story that they're telling is aligning with what the numbers are saying.
It's like making sure the script and the performance are in sync.
You got it.
Yeah.
Now, as companies mature and their growth becomes more predictable, the valuation process shifts a bit.
Okay.
And in Chapter 7, Damodaran explores these nuances of valuing those established growth companies. So these are companies that have proven their business model,
Okay.
and they've achieved a certain level of scale, but they're still expanding really rapidly.
So these are companies like Google or Amazon,
Exactly.
like the giants in their industries,
Yeah.
with tons of resources and global reach.
Yeah. They might not be growing at the same crazy speed as the younger startups,
Right.
but their growth rates are still really impressive, and their potential for expansion is still huge.
And Damodaran recognizes that these companies present like their own unique valuation challenges, right? Because their growth stories are kind of transitioning from that initial super high growth phase to like a more stable growth phase.
Right. Exactly.
So we need to adjust our valuation models to reflect those changing dynamics.
Precisely. He suggests using what's called a two-stage DCF model,
Okay.
where we project a high growth phase, and then it's followed by a stable growth phase.
Okay. So we're basically recognizing that growth will eventually slow down, even for the most successful companies, as their markets mature and competition heats up.
Exactly, and we need to account for that slowdown in our projections. We use different growth rates and discount rates for each phase.
And determining when that transition from high growth to stable growth will occur, that seems pretty crucial because it significantly impacts the overall valuation.
It is, yeah. And that's where a deep understanding of the company's industry, its competitive landscape, and its long-term prospects becomes really important.
We need to assess how sustainable their competitive advantages are, how effectively they're innovating and adapting to new technologies, and how they're positioning themselves for future growth.
Exactly. We need to be able to project how their growth engines are going to evolve.
Yeah. And whether they'll be able to maintain that market leadership when new challenges come up.
And that's where the art of valuation really comes into play.
It does. It's about blending the rigor of quantitative analysis with like the intuition and the judgment.
Right.
That come from a deep understanding of the business and its dynamics. Yeah. So we're using the numbers as a starting point, but then we're weaving in those qualitative insights, industry knowledge, and like a sense of the company's overall trajectory to create a more comprehensive valuation.
You got it. And that approach becomes even more crucial as we move into the realm of like mature companies in Chapter 8.
Okay. These are the companies that are often considered like the bedrock of the economy.
Yeah.
You know, the blue chip stocks, the household names, the ones with long histories of stable earnings and dividend payments.
Think Coca-Cola, Procter & Gamble, Johnson & Johnson, those kinds of companies.
Right. They've weathered economic storms, adapted to changing consumer preferences, and like consistently delivered value to their shareholders over long periods of time.
Yeah. They might not be the flashiest or the fastest growing companies, but that stability and resilience make them attractive investments for a lot of people.
And Damodaran recognizes that valuing these companies requires like a different mindset. It's less about betting on explosive growth and more about assessing their ability to maintain that strong position.
Exactly. He emphasizes the importance of assessing their operating efficiency,
Okay.
how well they're managing costs, generating profits from their existing assets, utilizing their resources effectively.
So it's like we're inspecting a well-built house, right?
Yeah.
We're checking the foundation, the plumbing, the electrical work, making sure everything is solid and well-maintained.
That's a great way to put it. We're looking for any signs of complacency, inefficiency, weight, anything that might be dragging down the company's value. Are they getting the most out of what they already have?
So we're scrutinizing their margins, their asset turnover, their return on invested capital to see if they're really squeezing every last drop of value out of their operations.
Exactly. And we're also looking at their financial restructuring potential.
Okay.
Can they optimize their capital structure by adjusting their debt levels or their dividend policy? Can they unlock value by buying back shares or maybe divesting underperforming business units?
So it's like looking for ways to kind of spruce up that house. Maybe a fresh coat of paint, some updated landscaping, just making it even more attractive.
You got it. And Damodaran provides a framework for analyzing those options and assessing what kind of impact they might have on the company's overall value.
He also introduces this idea of unlocking hidden value, which sounds interesting.
Yeah.
What exactly does that mean?
It's about finding those hidden gems within a company that the market might be overlooking. A company might have a business unit, for example, that's not performing as well as others, but it actually holds a lot of potential.
So it's like finding like a dusty old treasure chest in the attic. It might not look like much at first glance,
Right.
but once you open it up, you discover it's full of valuable jewels.
Exactly. Unlocking that hidden value could involve selling those assets, spinning them off into separate companies, or even just highlighting their true worth to try to attract investors.
So it's about seeing the potential that other people are missing
Mm-hmm.
and then finding creative ways to actually realize that value.
Precisely. And Damodaran reminds us that even in the world of these mature, stable companies, there's always room for improvement, innovation, and value creation.
This has been a fantastic deep dive. I feel like I've gained a whole new perspective on valuation. It's not just about the numbers, it's about understanding the story behind those numbers and using both the quantitative and the qualitative insights to make more informed decisions.
I'm glad to hear that. Damodaran's The Little Book of Valuation is truly a gem. It's practical, insightful, and engaging.
Well said. And for our listeners out there, remember, valuation is an ongoing journey. Keep learning, keep questioning, and keep exploring this fascinating world of business and finance.
And don't be afraid to really get your hands dirty with those numbers and those stories. The more you practice, the more confident you'll become as an investor.
Absolutely. Until next time, happy valuing.